So I'm gonna hit the record button. So welcome. It's the March version of tax strategies. Today's we're gonna talk a little bit about the usual tax advantages of having a home-based business or being self-employed or having a side hustle, a side gig, being a realtor, being a financial advisor. Lots of people want the specific. They want it's like Taylor's like, oh, I'm special. I'm this. It's like you're. I hate to break it to you, but you're not special. The tax system's a tax system, but there are two tax systems. There's a tax system for what I was for 20 years, an employee. I was a corporate employee. I worked for organizations doing accounting manager, finance manager, all that good stuff. I did that for almost 20 years. And for 20 years, I had next to no tax deductions. My car was not tax deductible. My internet, my phone, none of that was tax deductible, especially personal development. My favorite was not tax deductible for 20 years. And then one day I became a business owner. In hindsight, actually, I could have been a business owner sooner because you could be a business owner and have a day job. Those are the best because in your day job, whether you're in Canada or in the US, W3 employees, you pay source deduction taxes. And if you can write off some expenses, we can get some of that tax money back after. That's going to be part of today's conversation. The other part, a little spice it up, add something new is I did a presentation. I have some videos on it, but I'll give you the high level version. It's the 5 most common mistakes when it comes to income tax. All right, let me just keep an eye on the chat here. Do you deal with real estate? Yes, we can talk about real estate taxes too. Real estate taxes are interesting. So a couple quick things. I'm just gonna let someone else in the room. So one of the things I was just talking with this with a colleague half an hour ago is that income is not all taxed at the same rate. So let me say that one more time. All income is not treated equal. And there's different types of income and there's different tax rates for those incomes. So we'll talk about that first. First off, though, we're ready to go. It's quarter after. Let me quickly introduce myself. Why am I doing why am I here? Why am I doing all the talking? My name is Dwayne Richards. I am located in downtown Toronto, but because of the joys of Zoom and Zoom meetups, you could be anywhere watching us today, like Fran. Fran's here from North Carolina. It's beautiful. My friend Maureen,
Hiya.
Maureen's at Midtown Toronto. If Christina, I know, is in kind of Niagara area. So if you haven't already, just type in the chat. Just kind of let us know where you're dialing in from, where you're joining from today. The reason I ask is then I can kind of customize because now I know that Fran's here. It's not all about Fran, but I will generalize some stuff to say, hey, this applies to where you are. This doesn't. I always tell people I am a CPA, I am a tax accountant. I have a tax practice. So if you at the end of today, if you're more confused than when you got here, it's okay to raise your hand and reach out, and I will put a Calendly link in. And because you're here, you can book a complimentary call with me, and we can just have a conversation around what applies to you personally. If you're not comfortable asking your personal questions in a group setting, that's okay. You can book a complimentary call, and if you need help with your taxes, always looking for some new clients. So that could be you. What else do you need to know? Also, I am a licensed financial advisor, so I put the two pieces together in that kind of understanding the big picture of taxes. And I didn't always do this. I was a corporate employee until one day I was asked not to come back to work. It's called downsize, right size, fired, whatever you want to call it. And what I didn't have is I didn't have a plan B. I had a one-legged table, one source of income, and when that source of income was interrupted rather abruptly, it left me in a tough spot. Also, for 20 years, I paid a lot of stuff that wasn't tax deductible. Could have been tax deductible if only I would have had a side business or a side hustle, or just put up the sign to say I do. So we're getting some good questions here. So that's kind of what, and then I started doing this about a year and a half ago inside the 2 meetup groups. So there's a meetup group for CPAs and accountants, and then there's another meetup group called the GTA Business Leaders. Also sent it out to Meetup and to Facebook, some of my clients. So you got here from one of multiple ways. I don't care how you got here. I know all the ways work because you're here. That's all that matters. If you have some questions, like Jade's put in some questions already, which is great. Would you please share your business website? I'll tell you a little story about my websites in a second. Difference between leasing a car for the real estate business, also good question about leasing versus owning cars. So we'll touch on some of those after. Kind of speed through, get through the meat of it, and then we'll answer some of those questions. But thank you for putting the questions in there now, so we can address those as we get going. I'm going to do one other thing here, just because sometimes I'll be honest, sometimes I forget. So there it is. So that's my calendar link, and it's called Discovery Call. Books a 30-minute session. You get access to my calendar. You can just book it. It's done via Zoom. Nice thing is book it, books on my calendar, sends out a Zoom link to you, and we can connect. I just suggest if you're interested, do it sooner than later. It's tax season time, and the calendar gets filled up sooner than later. Even if you want to book it out a couple weeks, do it sooner than later. All right, enough of that. 5 most common tax mistakes. What do you think they are? Or what are some of the ones that, is there something that you've done that you think is like, oh, that probably wasn't, we learn, right? We learn from experience. So you can either come on mic or just in the chat, you can fire away. What do you think some common, Maureen, you can tell me, but don't take all the answers, because I know Maureen does taxes as well. So she's seen her fair share of mistakes. But you can share one just to get us started if you want. If not, we'll get started here in a second. All right. Number one, most common, as per me, like it doesn't really matter. They're all, there's lots of mistakes, but what have I seen most common from my clients is number one is filing late or not filing at all. Now you say, well, eventually they do file, so not filing at all, but that could be a mistake if someone just chooses never to file a tax return. Mistake, or filing late, a bit of a mistake. We'll talk about that, and we've seen that when it came to here in Canada, when it came to the CERB benefits, and all of a sudden everyone went to get CERB and they hadn't filed a tax return, and then they weren't necessarily eligible, or they weren't sure if they were eligible because they hadn't done a tax return. They didn't even have a My Account set up. And hopefully everyone here who's in Canada knows what their My Account is by now. If you don't, or better yet, if you do, just type in the chat, say yes, that you know what a My Account is. Just type in yes, so that I know that you're still awake and I'm not talking to your cat. So just type, Jana, thank you, yes. And also if you know it, but if you also have it. So just don't type yes if you know about it, type yes if you have one. Most people should have one by now, but never assume. Thank you, Maureen. I would expect that you would have at least one. You have a personal one plus one for your business. All right. Not fun, because and even if you get a refund, so I know people that get refunds and they're like, oh, I'll just file later. I know I'm going to get a refund. And it's like, well, Revenue Canada doesn't pay you interest on your refund. So why would you give the government money longer than you need to? So for example, I filed a new client. We filed their taxes yesterday. She's a mortgage broker. She switched jobs during the year. She switched from kind of social work to a mortgage broker. So 2 things. She has doubled up on CPP and EI. And if you wait more than 4 years or more than 3 years, 4 years on CPP and EI contributions, the government says, right, Maureen? Too bad. You waited too long, and they will not get you will not get your CPP and EI over contributions back if you've waited more than 4 years to file a tax return.
Dwayne,
yep.
Sorry, some seniors don't have computers, and that's been a big problem right now. Because are you getting calls with people not having, the seniors not getting their slips yet?
Not too many. Most of my clients have computers, even though I know, like, though there is like not even seniors, a lot of people relied on the libraries to go in to use the library computers. Now, the great thing is, as we're opening back up here in Toronto, because of the pandemic, I know that, for example, our branch here in St. Lawrence Market area, they closed it, and it was, I think it reopened on Monday, or it's this Monday, but they closed it because they're reallocating resources. So people that would rely on the internet and the computer in the libraries, those resources weren't necessarily available. I do have I have a couple clients that are not online. So I do have some clients in the city where I stop by their home and I meet them in the driveway and we do a paper exchange. And I get, like, I'll get a paper, like a pen to paper signature on their form, so that I can go in and I can download their slips for them. So there's ways to accommodate that. But you're right, there's not just seniors, that there's a lot of slips that are being kind of delayed and being put into the queue. So that's why I say, so the number one mistake is filing late or not at all. Number two common mistake is when it comes to credits and tax credits and not being aware of what you're eligible for. I just got off the phone with one of my advisory clients, an elderly woman. So she's in her late 70s. So she's looking to possibly do some upgrading to her home so she can stay in her home. So when it comes about accessibility, so if you're a senior or you know a senior and they need to put like handrails into bathrooms or do some work to their shower or in the stairs to make it more accessible, those, you can keep those receipts, and that those renovations and upgrades around mobility are tax deductible. In addition to medical expenses. So again, I have a client who's paid for her son's braces, orthodontics. Again, there's under the criteria, there's a whole list of items under medical. You get it's a tax credit. So it's not a tax deduction. It's a 15-16% tax credit, not a full deduction, but some money's better than no money. The issue with medical, it's kind of base capped. You have to have enough to get over based on your income amount too. Other credits, tax credits, is a common one that's not so commonly known if you're a single parent. So if you're a single parent, you live on your own with children, your eldest, you can choose one of your children, generally the eldest child, you can qualify as an eligible dependent. And what the eligible dependent spousal equivalent means is you can get the spousal amount, the extra $13,000 plus tax credit for that child. It equates to potentially an extra $1,500 to $2,000 tax refund because you're a single parent. And it falls under the eligible dependent. And they're wondering what their obligations for some property still here. That's a great question when it comes to clients departing Canada. So I see that, Janet, and we'll make sure we find some room to touch on that one today too, because that's a great question. So again, just some common tax credits. There's a tuition credit. So also childcare. So one of my clients, but again, when it comes to childcare, make sure anything is make sure you have the receipts. One of my new clients, she paid almost $8,600 for daycare for her 3-year-old. So again, that daycare credit goes in, and that triggers a tax credit when it comes to daycare. Tuition. So if you pay for my eldest son's applying for universities for the fall, and if he doesn't have enough income to use up his tuition, he could transfer that tuition to either me or to his mother. So tuition is another thing where you get the tax credit, not the full tax deduction. I'm gonna switch sides. I got a strip of sun coming in the blinds. I'm gonna switch sides here so my back stays straight. So those are tax credits. So the second most common thing is just people not being aware of what credits are available because something has changed. They just said, I did it this way and I'm going to do it this way again. And do it again this year and I'm going to continue. And with my client I was just talking to, she may be eligible for the disability tax credit as a senior. As your mobility decreases and you need more support, you can actually apply. There's a form to fill out. You have to get, it's in conjunction with your doctor, but you can qualify for the disability tax credit. Again, we're talking about a close to $8,000 tax credit if you have a disability. So it could be a hearing impairment. Generally, there's like 5 criteria. If you're one of 5, like if you're not able to feed yourself or get dressed or using the washroom. So there's kind of daily bodily functions. And if you need support and help with those, then you can qualify. But there's also some other things that also, so don't assume it's just has to be a severe disability. Not the case. So there's a form, and if anyone needs, I can, if you're curious about that, just type in the comments disability, and I can find that and I can send that to you. You can also search for it on the CRA site, but it's always better to have someone search it for you. So number 2 was credits. Number 3, most common tax mistake, deductions. So guess what? You've raised your hand. You're like, I'm self-employed. I have a side business. I have a side gig. I have something. And you start claiming, or network marketing, you get a commission check. So what happens is, or financial advisors. So you're a new financial advisor and you're starting to get your commission check, which is great. Get my commission check, and they didn't take any source deductions. So they didn't withhold any income tax, and they didn't pay any CPP, and they didn't pay any EI. So you just get this income check and it comes in on your T4A. And then you're like, oh crap, I owe a lot of tax. That wasn't great. I just gave myself a tax bill, and people get discouraged and they quit, and because they have a tax bill. But guess what? You're going to owe a little bit of tax, but you're not going to owe it all because there's some deductions that are available. Deductions. What happens is, if I use financial advisor, because I think we have 1 or 2 financial advisors here, it's a pretty good example to use. Your financial advisor, you get a T4A from your insurance company or advisory business. They say, hey, you earned $20,000 worth of commissions. Deductions get deducted against that income before we calculate the income tax. So if you have a job, you got your job, and the employer is so nice, they take EI, CPP, and income tax, and then you get your money later. We can get some of that money back, but if you're a financial advisor, you didn't pay any tax. And so what we can do is we can deduct your phone expense, we can deduct your internet, we can deduct a portion of your car, we can deduct a portion of your home office, we can deduct personal development, any training courses. We can now deduct 100% the courses, because now we're deducting under self-employment under personal development as opposed to tuition. We can deduct marketing and advertising. So for example, if you're a realtor and you give a gift card to someone as a referral, thank you, that gift card can be deducted under marketing and advertising, unless of course it's LCBO and food, which it then falls under meals and entertainment, and you only get 50%. You can still do it. 50% is better than no percent. Just be aware that if you're giving gift cards that are more meals and entertainment related than other, and if you're more confused, it's even more reason why you should book that discovery call with me. All right, so number 3 was deductions, just not knowing. And I'm not going to give you, there's a whole laundry list. There's a huge list. There's like a whole website called CRA listing out all the deductions that are available to you. I'm not going to give you all of them today. I'm just giving you some examples just to get you thinking. Number 4 reason, probably some people in the room do this. What do you think the number 4 reason most common mistake is? Who's a DIYer? Raise your hand. Put in the comments if you're a DIYer. You're a do-it-yourself person. It's okay. That's probably what you learned. Your parents did their own taxes, so you're like, oh, I'm a grown-up, I'll do my own taxes. If you're a DIY or Fran's guilty, that's okay. It's okay. The first step, it's like it's a 12-step process. The first step is to admit that you didn't do anything wrong. You could be fantastic. You could have an accounting degree. You could have an accounting business like Maureen. DIY is fine. Even I went to, not about me, but I went to university. I actually have an accounting degree. I have an accounting designation. Not until about 8 years ago, and my birthday is next week. So if you want to come by for the birthday party next week, come by next week for the birthday party. But not until like 9 years ago did I learn any of this. I spent 20 years paying way too much income tax. And I was a licensed accountant, but I practiced corporate accounting. I didn't practice personal income tax. I didn't do corporate taxes. I was like financial advisor, running accounts payable and stuff like that. Salary and payrolls. I didn't know anything. I know a lot more now, but I don't know everything. Why would you assume that you know everything? That's why you're here. You've done step 2. Franz, you're now on step 2, Fran. You showed up today with step 1. Step 2 is like, I do my own taxes. It's okay. That's step 2. Step 3, click on that discovery call button and go book yourself a call. I know, blatant. It's okay to do this. You're here for free. I can't do a little bit of self-promoting. Who's going to promote me? Maybe my client Mark might come on here. He might promote me, but we'll see. But Mark's here today too. Mark already works with me. Hope he doesn't mind me saying that. He referred me to one of his friends, but he is also here to learn. Hey, good to see you, Mark.
And the same. No, yeah, you did my last 2 tax returns. There's no way I would have been able to save that much money without you. No way. Yeah. I wouldn't know what to claim.
Yeah. I didn't even pay him. I didn't even pay him to say that, but it's nice for you to join us today. Thank you. So he was a do-it-yourselfer, and then the reason I learned about Mark was one of my clients works with Mark, and Mark had a side hustle. He was doing yoga and some stuff, and my client had a yoga business. She's like, "Oh, Mark, you need to talk to my guy because he understands side businesses," and we saved him a bunch of money. Nice, all legitimate, all above board. It's great. So number 4 mistake is just doing it yourself. It's okay. Sometimes people think, oh, hiring an accountant is really expensive, Maureen. Hiring an accountant is really expensive. Not hiring an accountant is even more expensive because you're leaving money on the table. Quick thing, just so while you're here, my price, I'll do a general plain T1 personal return for as little as $50. Now it goes up a little bit if you have a self business, but that's it. For the price of buying TurboTax yourself and pulling your hair out on a Saturday, I'll do your taxes for you. Who wants to, no one wants to do that. Anyone want to spend tomorrow? Sunday is going to be 13 degrees here in Toronto. You want to spend Sunday in your basement shuffling through the tax act, or get outside and spend your time Sunday in 13-degree weather with your family? Give it to the accountant. All right, enough of that. Number five reason, most common mistake, not having a plan. People don't even have financial plans, but people don't even they don't even have a clue about a tax plan. A tax plan, you're like, what is a tax plan? A tax plan is like being short-sighted and missing the big picture. So short-sightedness is, I'm going to put money into my RSP because the bank did a really good job advertising. My financial advisor did a really great job advertising to me and told me it's RSP season. So I just got a job. I'm making 40 grand a year, and the bank's telling me to put money into my RSP. Good idea or not? Not a bad idea. The issue is if you have tax-free savings room, because you're in the lowest tax bracket. Quick lesson about tax brackets. There's about 4 or 5 of them. The beginning tax bracket, you pay tax at like 20%. So when you put money into your RSP in a $45,000, you get 20 cents on the dollar. 40 years later, you're more experienced and you're making more money and you have more income, and you have all this money in your RSP, and you start taking it out, and your taxable income's like $50,000, you got to pay a different tax bracket. So you're paying more on the way out than they gave you on the way in. Here's what it is. One of my clients, he's a sales rep for Salesforce. His check in February was $230,000. His taxable income's over 400,000. He's in the 53% tax bracket. He's dumping money like crazy into his RSP because he's not going to be making that money forever. He's getting 53 cents on the dollar kicker for his RSP contribution. You want 53 cents on the dollar or 20 cents on the dollar? Save your RSP room for when you're later, or until at least you've maxed out your TFSA. So the long-term plan we talked about, and it also says, like, so someone asked about real estate, some other things, not all income is treated equal. Earned income and interest income is taxed at 100%. So your paycheck, you make $1, Revenue Canada charges you tax on that dollar, no deductions. Dividend income. So if you own a bank stock, I own a couple in my TFSA, but if I own a bank stock out of my TFSA, bank stocks, I can't tell you which one because I'm not licensed to, but bank stocks pay quarterly dividends, roughly 4 to 5%. And that dividend is taxed at a dividend, and there's a dividend tax credit. So generally you pay tax on 2/3. Paying tax on 2/3 is better than 100%. You get a third of break. Capital gains. So if you own stocks or if you own a second property, not principal residence, principal residence is tax-free. Capital gains on stocks, 50%. So you take your gain, multiply that gain by 50%, and then you pay the marginal tax rate on the gain. So you get 50% for free, no tax. More risk. It's kind of a thing. That's the way the tax system works. The more risk, the more benefit. No risk in your earned income, no tax benefit in your earned income. So number 5 is just not having a plan, not having different sources of income and different tax, and understand that you can earn income at different tax rates. Okay, how are we doing so far? Let me take a pause. Anyone have any questions? You can come on while I take a drink, and I'm just going to do a quick read of the comments so that I can spend the next 25 minutes answering what you really came here for. Fran, I do have some experience about corporations. Corporations are a little bit different in Canada than in the US. I will touch on that though. And if you have any questions, I do have a good contact, a colleague, referral partner in the US. So because you are in the US, I can refer you to someone who knows a lot more about the US than me. Do we always need to have a corporation register to get expense deductions for a financial advisor? Nope. All the stuff I talked about don't need to be incorporated. And I'll touch on that a little bit in a second. What is some home renovation tax? What about some, home renovation tax? So the home renovation tax credits is when it comes to for seniors, and it comes to accessibility, those home renovation tax credits are more for around accessibility. If you're just a Joe and you're renovating your home office or renovating your basement, not tax deductible. Unless you're doing it to renovate to create a rental property, then there's some other things. Okay, I just want to read this one about, I have a few clients who left Canada in Europe and wondering what their obligations. Some have property still here, some not. Okay, so I will touch on that exiting, because lots of people are thinking about, they're not sure, not a political comment, but lots of people aren't really super happy with Canada. And so they want to get out of Canada and either go to the US. I have a couple of colleagues that are in Costa Rica. Just go somewhere. So I'll explain, that's a great question. So I'll touch on that one actually right now. And then, do you have a basic tax plan in a doc to give out to people as a starting point or a template? Yeah, I do have some stuff, Mark, where we can kind of share some stuff. So that goes back to that discovery call. I know Mark booked his already. He's already a client and he's booked more time with me. Isn't that amazing? Like, why wouldn't you use your accounting resources? All right, so yeah, so if you book that discovery call, I do have some resources that I will share. I just don't send it out to randomly because I may send it to you, may never use it. It's better to have a call and let me explain it and give it to you. Okay, the mass, they talk about the mass resignation where like people are quitting, like dropping like flies, they're quitting their jobs and they're leaving their corporate worlds and going to do something else. I'll touch on that briefly here in for 1 second, and then I'm just going to let someone else in the room. I'll touch on that around just some things that you should be aware of when it comes to before you leave your corporate job. Just some big picture, not necessarily tax things, but kind of tax related. So when you leave your corporate job, and then we'll talk about the leaving Canada and some tax consequences if you're kind of in and out of Canada versus like long-term out of Canada versus like never coming back to Canada. All right, is that good? Or would that be useful? I'll just do a quick little survey. Would that be useful or relevant to most people? I'm gonna talk about it anyway, but if there's something else, then always just type it in the comments and I can touch on that too. Okay, great. First off, I didn't usually talk about it just as a seed. I'll plant the seed right now. I didn't really touch on it yet, but I'll just quick explanation. So, and then Fran, this is for Canada, but I'll kind of give a quick US version of it too. I wonder if you're sharing a slide, or yeah, I don't have any. I don't really have. I have some slides around the home business side. But if you want that, I can actually, I've recorded it and it's sitting on YouTube. I think today is a bit more free flowing, but if you want slides, then what other thing is that you can also drop your, email. You can also add your email in the comments. And if you just drop your email, then I'm more than happy to send you some slides about some content that I usually speak on. Today just seems a little more free flowing, and I'm not lazy. I was like talking off script. More it's like this when questions come up because I don't have slides for all your questions. So let me just talk about quickly the people that decide, and this is one of the areas that I love working with clients that are in transition or deciding to transition. They're planning to transition from full-time employment to being self-employed or running a business or a side hustle. Great, do that, but just plan it so that start the business while you're still working, because we can claim the startup costs against your taxes paid, whether you're in Canada or the US, you can do that. The other thing to be aware of is if you like have a mortgage or want to get a house or buy a house, is get the mortgage approval and maybe even lock in a 5-year mortgage before you leave your job. The problem with self-employment is it can take a little bit while to get going and get started and to show like some regular income, and lenders don't really lend to people that don't make money. They do lend money to people that have a T4 job and have a letter of employment and have a steady cash flow. So my strong suggestion is if you're thinking about transitioning, lock in, and you own a home now or want to own a home, lock in that mortgage for 5 years. Yeah, the rate may be a little bit higher on a 5-year fixed, but it gives you the peace of mind that you're not trying to renew in year 2 and your business is still not quite where you thought it would be. So that's tip number 2. Tip number 3 is just be aware that in your job, you generally get a lot of benefits, and benefit plans are a little bit pricey on the way out. So when you all of a sudden have to pay to go to the dentist yourself, and you go to buy, and you decide, I'm gonna get a personal health plan. Health insurance isn't free, and health insurance, they don't pay out more than they charge you. So make sure that you have a plan B around medical, especially if you're on prescriptions or if you have like a already existing medical conditions. Just make sure you either set some money aside or you prepare for self-funding. There is the tax breaks, there is a health spending solution, but just be prepared for that. because a lot of people forget about that piece. They forget what benefits is truly worth to them until they need them. And number 4 is CPP, because guess what? In your job, you pay half the CPP. Your employer pays half. When you're self-employed, you pay the full 10%. So, and that equates to, on your first $65,000, 10%, because it's about $6,300. So on the CPP side, just be prepared. So when I tell my clients that are now self-employed, set aside 10% for CPP and set aside another 20%. So the first 30%, 30 cents on every dollar that comes in for self-employed people, right, Maureen? Yep, 30%. That's not your money. Put it over here for the tax account for the taxes in March. If you don't need it all, the leftover money is yours. So example, one of my clients, she did this. She was setting aside money. She set aside like $6,000, and turns out she actually has a tax refund. So not only is she getting $2,000 back, the $6,000 she set aside, she doesn't need. So she actually has $8,000, which is fantastic. She was super happy because she's planning to move in May to Prince Edward Island. So she's like, I'll be using that $8,000 to pay for the move, which unfortunately is not tax deductible. So if you're self-employed people, Tammy self-employed. Tammy, when you moved from like London to Toronto as a self-employed person, move tax deductible? Not so much, because it's an employment deduction, and you have to be moving at least 30 kilometers closer to for employment is generally the rule. It's one of those older rules that they probably could upgrade. One of my clients moved out of the city to Hamilton, but both him and his partner, she works from home and he is self-employed. So their move to Hamilton, not tax deductible. Okay, so that was the whole idea of this moving from, then I said I would touch on some tax advice.
Wait, I have a question.
Okay.
Thanks. I didn't know how to raise my hand in the Zoom thing
Usually
yet.
down
I'm
at the
still-
bottom under reactions, if you click on reactions down at the bottom, but depends if you're on your phone. Like I know on
Oh,
my
there we
desk-
go.
There you go. There you got your hand up. There we go.
Hi, quick question.
Yep.
Would it be tax deductible if you were doing previous business inside of the area in which you want to move? For example, if you were looking into, let's say, a rental property, probably a year or two prior before you moved, would that technically be tax deductible if it would be a part of your business? I don't know if I'm wording that right.
Yeah, I kind of know what you mean. So unfortunately, no. But when it comes to rental properties, the nice thing is that travel related to rental properties is a tax deduction. So for example, one of my former clients lived here in Toronto, and he had a property in Florida. So once a year, he goes on a family trip to Florida. So he could, like, not just to see his property, but you also make a note that you drive by the property and make sure that a hurricane or something didn't wipe out your house, and just stop in. But as a result, because he's there to see his property, the whole trip to Florida can be tax deductible as a business.
I think what I'm specifically asking is that, like, okay, let's say hypothetically, let's say I had a property in Florida, right?
Yep.
And I had it a year prior to my move, or 2 years prior to my move was already done.
Yeah,
and over with.
so in Canada, the answer is no, because it's related to self-employment. So you're not moving in there for work. So you're not working, say if you're working from home for Home Depot, and Home Depot is relocating you to Florida, or you're moving to Florida because you got a better job at Home Depot, then the move to Florida becomes tax deductible because it's moving for work. If you're moving for personal, like self-employment, personal business, generally the answer is no. In Canada, the answer, so what I can do is I can introduce you to my colleague, Courtney. Her name's Courtney Epps. She does outside the box tax based in I believe it's North or South Carolina, one of the Carolinas. She's there she's in your neighborhood. And then she's actually like a IRS agent for the IRS, not agent, like not in a bad way, but she works for the taxpayers, but she has she's a E, I think it's a EA. I forget what it is. There's a US tax certification she has, but she works with entrepreneurs. She's on the stage with Tony Robbins and Eric Worre. So she's wrote a book called More Relaxing, Less Taxing. So she would be the person, and she has a business in Carolina for taxes. So she would be, I can send you, if you send me your email, if you drop your email in, I can do an email introduction into Courtney, and she could give you kind of the US specifics on that, because it might be. So here in Canada, one other quick thing was around corporate. When do I incorporate versus I'm running my sole proprietor? So I generally say three reasons: taxes, liability, and because you have to. From a tax point of view, generally it's when you're making money. Running a corporation costs money. It takes money to make money, as they say. And generally, when you're doing revenue over 100,000 and you have cash that's in the business, and you're at a point where you're not needing every nickel of your business money to be personal, and you're leaving money to reinvest in the business, now it's time to incorporate. If you need every nickel, if you're taking every nickel out of your business to fund your lifestyle, no good, because you're paying corporate tax, plus then you're paying personal tax. So that's not a great idea. The reason why you want to incorporate, it gives you an option because you can pay yourself a dividend income. And what we learned about dividends is dividends are taxed at a lower rate, but dividends are not earned income, and dividend income does not trigger RSP room. Probably another reason why you should book a discovery call, because I've just confused you even more. Okay, now we got 10 minutes quickly to talk on the mass exodus out of Canada, because everyone doesn't. I love Canada. I've been here. Just a quick side note. One of the arms of my tree on my dad's side, they were the first settlers to Scarborough. They were the first they actually donated land to the Presbyterian Church in Scarborough. So my ancestors have been here in Canada for like 5 or 6 generations. Doesn't make me any better. It just means we've been here a long time. My ancestors have been here a long time. I don't plan on leaving, but I am thinking about at some point when we retire to possibly spend 2 or 3 months where it's warmer outside of Canada. So here's what you need to know. First off is taxes are driven by your residency, right? So if you're a Canadian resident, you pay taxes. You can pay taxes. If you're a Canadian citizen, you could also be here on a work permit, or you could be here on a PR, a permanent resident card. You don't even have to be a Canadian citizen. You could have a PR card, have a SIN number, and guess what? Welcome to Canada. You get to file taxes. And I do have a couple clients who are spending large chunks of time in Costa Rica. If you're outside of Canada for consecutive, not the number 4, but FOR, more than half the year, right? 183 days or so. If you're outside, then you potentially are no longer a Canadian resident. And you're like, what does that mean? It's a good question. You have to, there's not consequences yet, just have to be aware is if you're outside of Canada for possibly more than 90 days, your OHIP may not be, you may not have OHIP coverage. Also be aware that OHIP doesn't necessarily cover you even if you go out of the province anymore. They changed those rules like a year ago. So if you're traveling outside of Ontario, you always want to make sure that you have health. Somebody I know, he was in Mexico, he's been living in Mexico, and he was in a boat ran him over while he was swimming. No medical coverage. That gets really expensive. You got to protect your assets, protect your income, and that you do that with insurance. If you have questions about that, you can also talk to me about that later. All right, so because we think, what is our OHIP worth? Our OHIP is worth a lot. I can go to the hospital and like get coverage, and it doesn't cost me a nickel. I have to use a lot of after-tax dollars to pay for healthcare if I need it somewhere else. So tax-wise, though, what we're talking about taxes. So all of a sudden, you could be treated as a non-resident. You still have to file taxes because you have a connection to Canada, and now you're filing as a non-resident. Different tax, a little bit different taxes. It's different than if you leave permanently. I have a client who lives in Mexico. He's 83 or 4, and he is a non-resident. He's not coming back to Canada, and he's still a Canadian citizen. He's just not a resident. So on exiting, you have to dispose of your stuff, some of your stuff. So you dispose of property, and specifically you have dispose of equities, stocks. So you can't continue to, you can't necessarily, again, I'm not the expert, I just know the high level stuff. So if this is you, then always book a call and we talk about it specifically. Now he has a pension, he has CPP, he has OAS, he's still eligible for those, and he has a pension, still eligible. And what happens is, because he's not a non-resident, he's not a resident, he's a non-resident, is there's withholding tax at source. So his pension, they withhold tax, and they issue an NR4 form, and they withhold income tax before it goes out to him. He still has to file a tax return. He has to file a tax return for Canadian, as well as there's worldly income. So you have to file that. So the challenge is, and what kind of attachment do you have? I have a colleague has a corporation, so she still has a Canadian corporation, but now she could be deemed a non-resident holder of a Canadian corporation because she hasn't been in Canada for 2 years. She's kind of left and just hasn't come back. So there, but she still has, her parents still live here. She doesn't own any real estate. So again, when you start going in, if you have an audit or questions by CRA, they start to say, what connections do you still have to Canada? So if you still have like a rental property, or if you have a condo or a house in Canada and you're renting it, you just don't live in it, then you still have a tie, you still have a connection to Canada. If you had a car and you just park your car at your friend's house, you say, well, I still have a car, I still have some asset, I still have some stuff in Canada, then you still kind of have connections. But if you like liquidate and you're like, see you Canada, I'm out of here, then you actually have to file a form that says, I am now declaring as a, I now have to, you have to tell that. So then you fill that non-resident tax thing out properly. That's kind of the gist of it. The other thing though is because it just top of mind is, if your whole, I don't really deal a lot with cryptocurrency. I'll be honest. I don't personally deal with cryptocurrency. Not that I don't believe it does exist. So I'm not conspiracy theories. I know that cryptocurrency exists. I just don't, for personal reasons, I just don't deal with it. However, if you do have cryptocurrency, there's the, or other assets outside of Canada, there is a form that you have to fill out. It's like, do you own, there's that check. It says, do you own foreign property? When they talk about foreign property, there's a definition of property, and it doesn't just mean real estate. It means stocks, investments, including cryptocurrency. It's property, it's digital property, it has a value. And if that property value is greater than $100,000, you need to declare it on that form. And if you fail to declare it, they will ding you a daily penalty for failing to disclose outside Canada property. Don't hide stuff, be transparent. If you're thinking that, oh, it's a decentralized deal, this, that, whatever, and you think that Revenue Canada can't find it, good luck with that. Continue to believe that if you wish. But as some people found out, and this is not a political statement, this is just, I'm not on either side of the fence, but as some people found out recently, when you decide to like get angry at different people, they can like find your stuff and take it or freeze it, including what they're doing in Russia. Now, it's not a political statement, but as the Russian guys found out, is that when you're on the wrong side or the right side, depending on what side you want to call right or wrong, even worldly things can get like frozen or confiscated or other. So just be aware. There's no hiding. And tax deferral is not illegal, but tax avoidance is illegal.
I have a really important question.
Public service announcement for you. Yep, fire away, Fran.
Okay, so in the chat, I put crap, not like, oh, I feel like it's crap, like, oh, crap. Wait, I have a question. So good question. You said if it's over $100,000, because I only got like $700, and I was like, okay,
Just
cool.
But just in Canada, so the rule, again, that's a very Canadian specific rule. So
Oh, thank
for
God.
a specific Canada rule is that we actually have it's called a T1131, which
Mhm.
is declaring of outside the country property. I'm not sure what the US. So again, that would be having a conversation with Courtney or a tax professional in the Carolinas to figure out what is, because you have both federal and there's state rules in the US, like similar to Canada. We have like Ontario, but generally we have the CRA is the Canadian Revenue Agency, like you have the IRS. So that we have CRA for Canada, you have the IRS, but even with the IRS, you also have state. So what, like for example, in
Regulation.
Florida, lots of people go to Florida because there's no like income tax per se in Florida, but there's other taxes. So I always tell people wherever you are is also, if it's not in Ontario, then always seek out kind of a tax expert in your area, because they'll know what specifically applies to you. I touch on the high level, but generally is to come here and get more questions than answers. So then you realize like, oh, okay, I better stop being a DIYer and I need to seek some professional advice. In which case, either that professional advice is from me later, like one-on-one, or in your case, I can connect you with, if you need, I can connect you with a US colleague to answer kind of US specific stuff. So, all right,
I would appreciate that.
all right,
you.
we're pretty good for today. Let me just take a quick look. Yeah, so I do have a guide. Oh, it's actually a different Betty. I thought my apologies, Betty. I thought Betty was I have a tax client called Betty. So I thought Betty, I never assume. I thought Betty was my tax client, but she's not my tax client. So Betty, I got your email, so I can send you some resources around, because the presentation I do in the past has generally been a lot around like home-based business, network marketers. I do presentations for network marketing businesses. We've done them for ASEA, for Young Living, for Juice Plus, Beachbody. They're all the same in the sense that they all have the same tax advantages. So I do have some resources I can send. I know you sent it to me as a private message, Betty, but I can help you out on that. All these must comply with federal. Yeah. So the whole Mark's more aware about cryptocurrencies than I am. You're right. And even so, I just had a conversation with a colleague around Wealthsimple, because like Wealthsimple, you can buy and trade kind of like currencies, digital cryptocurrencies on Wealthsimple. I'm really curious to find out, because other thing, like if you're doing stuff with like RBC or TD or CIBC and you're trading equities and stuff, they issue you a T3 and a T5. I'm not sure. And if anyone is doing some cryptocurrency, I do have a link to a CRA Revenue Canada, Canada.com article or bulletin around the record keeping requirements for cryptocurrency. So if you want that link, again, you can just put your email in the chat and just type in the word cryptocurrency or crypto. Crypto's easier. Don't mind, make you type everything. But if you do want that, and it's not mine, it's on CRA's site. It just says this is what you need to know. It's like date of purchase, purchase price, date of trade, and you have to do more of the work yourself. So if you're actively day trading it, you just need to find out, like, either does your exchange provide that to you, like some sort of summary report, because you got to be able to calculate the gains or the losses. Why are we always assuming everyone's making money? There's lots of people that have lost money. And if you recognize that's a capital loss, so you can actually realize a capital loss and use capital losses in the future. It doesn't reduce your taxes. It just creates a capital loss that can be used in the future against capital gains. One of my clients, he is doing some option trading. He's still learning and triggered a capital loss. And then he sold his rental property. I think we can actually apply, because they're capital losses, we can apply his losses against his gains to help reduce the taxes owed next year when he has to pay capital gains on his rental property. All right, how did we do today? We're still there. Testing. I'm gonna stop the recording because they don't